Welcome to the deep dive. Today, our mission is, well, it's pretty unique. We're going inside a financial fortress right at a moment of global panic. We're looking at a specific source, the 2019 shareholder letter from JPMorgan Chase.
Yeah, and the timing is just critical. The letter covers 2019's results, but it's dated April 6, 2020.
Right when everything was hitting the fan.
Exactly. So you're reading about record profits, and then bam, it pivots hard to the greatest health threat of a generation. It's quite jarring.
It really is. It's like a time capsule of whiplash, part financial report, part instant crisis plan. So we're digging into how this institution, one that calls itself a fortress, deals with that kind of extreme shock.
We'll look at the foundation they laid in 2019, the incredible pivot in early 2020, and what they revealed about their own resilience, both financially and socially.
Okay, let's start with that foundation. Section 1, 2019. Because it wasn't just good, it was, well, a blockbuster year.
Oh, absolutely. Record revenue, $118.7 billion. Record net income, $36.4 billion. But the key point they stressed.
It wasn't a one-off.
Precisely. It was their 9th record result in 10 years. That consistency, that history, is what backs up the whole fortress balance sheet idea.
So the fortress concept, it's about holding more capital, more liquidity than required, preparing for the unexpected.
Exactly that. And they give some tangible metrics. It wasn't just passive. Core loans were up 2%, deposits up 5%.
And they were actively deploying capital.
A huge amount. They extended credit and raised capital, totaling $2.3 trillion for customers and businesses in 2019 alone. They were really fueling the economy right up until the brakes slammed on.
And looking long-term, that performance paid off compared to the market.
Significantly. Since the 2004 merger, their stock's compounded annual gain was 12.2%. The S&P 500, 9.2%. So clear outperformance.
But here's where it gets interesting, and credit to them for including this. The volatility hit was immediate and brutal.
Yeah, they're very upfront about it. They actually put in a footnote showing the damage. End of December 2019, their total gain since the merger, 442%. Then, end of March 2020, just 3 months later, that overall gain was slashed to 252%.
Wow. Almost half the long-term gain wiped out in a quarter.
Right. Even for a fortress. It just shows the sheer speed and depth of the market panic.
So that really sets the scene. They weren't relaxing after a great year. They were immediately in crisis management mode.
Absolutely. Which brings us right to Section 2, crisis mobilization.
Dealing with this extraordinary crisis. Okay, operationally, how does a giant firm like that, processing trillions daily, even begin to react?
The speed is honestly staggering. They had to get, over 180,000 employees working from home fast.
And not just standard office staff.
No, that's the crucial part. Traders, call center teams, people in highly secure, tech-heavy roles. It really speaks volumes about their prior investment in digital infrastructure and resilience.
What about the physical side, the branches people rely on?
They kept about 3/4 of their 5,000 Chase branches open. And maybe more importantly, almost all the drive-up windows, around 2,300 of them, stayed operational.
A safe way for people to bank during peak uncertainty.
Exactly. They acknowledged the call centers were overwhelmed initially, partly due to local restrictions, so they quickly built digital tools for customers to request relief automatically.
Let's talk about that relief, the lifelines for consumers. What specifically did they offer? People were losing jobs overnight.
The focus seemed to be on immediate cash flow relief and, frankly, dignity. So a 90-day grace period on mortgage and auto payments. Waived late fees.
Okay. And credit cards?
Similar approach. Removed minimum payment requirements, waived the late fees there too. But maybe the biggest thing.
The credit reporting.
Yes. For clients who were up to date before the crisis hit, they committed not to report these payment deferrals to the credit bureaus.
That's a really big deal. It signals they saw this as a systemic shock, not individual failure. Protects people's long-term financial health.
Absolutely. Treating it like a natural disaster scenario. Now, shifting to businesses.
They stepped up lending there, too.
Immediately. In the 60 days just before the letter, they pushed out $950 million in new loans, just to small businesses.
Was that enough, though? Or more symbolic?
Well, look at the bigger picture. Their corporate clients drew down over $50 billion on their existing credit lines. Just hoarding cash.
$50 billion. How does that compare to, say, 2008?
That's the startling part. It dramatically exceeded the drawdowns during the entire global financial crisis.
Whoa.
It shows the nature of the shock. It wasn't a slow burn like '08. It was an instant reflexive grab for cash because nobody knew what was coming next.
That drawdown number really paints a picture of the fear level. And where else did they direct funding?
Right into critical infrastructure. In March alone, $1.9 billion more for hospitals and healthcare companies, $270 million for educational institutions, $240 million for state and local governments. Bridge funding, essentially.
Keeping the lights on for essential services. Okay, Section 3, financial transparency and stress testing. Facing that kind of fear, they had to show the market they were solid. Stopping buybacks was step 1.
A clear signal of capital preservation, yes. Then they leaned hard on the stress tests, the CCR process. They basically said, look at our 2020 submission.
And that scenario was already pretty grim, right?
Oh, yeah. It assumed 10% U.S. unemployment, a 50% stock market crash. Serious stuff.
And even under that scenario,
they projected staying profitable every quarter and maintaining a really strong capital buffer, a CET1 ratio of 10%. That's a lot of cushion against losses.
So stable under the standard bad scenario, but they went further.
They did. They ran what they called an extremely adverse scenario. Think like total meltdown contingency planning.
What did that assume? Sounds scary.
It was a 35% GDP contraction in Q2 2020, unemployment spiking to 14%. Basically Great Depression levels.
Good grief. And the fortress under that?
Still standing.
Yeah.
CET1 ratio projected around 9.5%. They did note the board would probably consider suspending the dividend then, mostly out of extreme caution.
Makes sense.
But critically, even while modeling that Armageddon scenario, they publicly committed to lending an additional $150 billion to clients.
Wow. $150 billion more.
Yeah.
Even if the economy completely cratered according to their own model, that's confidence.
It's a massive statement about their belief in their own balance sheet strength. But, and this is important, they also flagged a constraint.
Ah, yes, the regulatory point. What was that?
They pointed out that if things did get that bad, the extremely adverse scenario, then existing regulations might actually limit how much more they could do to help clients, even though they'd still have plenty of capital and liquidity on paper.
So the post-2008 rules, designed for safety, might inadvertently restrict support in a different kind of crisis. That's a really interesting tension. We should definitely circle back to that.
Agreed.
Okay, moving on. Section 4, employees, community, and inclusion. You can't manage a crisis without your people. How did they support their own staff through the initial shock?
They recognized the personal toll, gave everyone 5 extra paid days off, specifically for things like dependent care, personal illness, just managing the chaos.
And for those who had to be on site,
Yeah.
the essential workers.
A special payment, up to $1,000, for those employees full or part-time who had to physically come in and earned under $60,000 annually. Direct help for those taking on more risk.
That seems right. Now, the letter also pivots to broader social issues. They stress that diversity and inclusion remained critical, even with the health crisis dominating. Why include that so prominently?
I think they understood, or at least articulated, that the pandemic wasn't happening in a vacuum. It was exposing and worsening existing societal cracks. So first, they pledged $50 million immediately for humanitarian aid and longer-term economic recovery efforts related to COVID.
And internally, they addressed some issues there too, right? Mentioning specific efforts.
Yes, they directly acknowledged past allegations and stated a commitment to root out racism and discrimination. They listed concrete actions: mandatory D&I training for everyone, improving how employees could raise concerns, strengthening hiring practices.
They mentioned the Advancing Black Leaders program specifically.
They did, citing a 50% increase in Black managing directors and executive directors over the previous 4 years.
Which sounds good on the surface, a 50% jump. But, the question always is, 50% of what starting number? Does it actually reflect real parity yet?
That's the perennial challenge with D&I metrics, isn't it? The letter highlights the positive trajectory, the effort. But interestingly, it also included this really blunt critique of the nation's historical failures.
Right, the part about the Civil War ending 150 years ago, yet parity for the Black community still hasn't been achieved. That wasn't subtle.
Not at all. It was a direct linking of present instability to unresolved historical inequities. Quite a statement for a bank CEO's letter.
It leads perfectly into the final section, doesn't it? Section 5, looking ahead, the policy agenda. They shift from managing the bank to advising the nation.
Exactly. The most immediate need they identified: a national back-to-work strategy.
And the linchpin for that was testing?
Testing, testing, testing. Specifically, widely available antibody tests, serology testing to figure out who had recovered and might have some immunity. They urged government at all levels to massively accelerate this.
The idea being, if you can certify immunity, people can return to work more safely, restarting the economy. An early push for, immunity passports.
Pretty much. But then the critique broadened. The CEO argued the pandemic starkly revealed long-standing American problems.
Yeah, he listed them out, quite frankly. What were the main ones?
It read like a list of chronic national weaknesses. Ineffective inner-city schools, a healthcare system that's incredibly expensive but leaves many behind, poor infrastructure planning, government waste.
So, connecting these domestic failures directly to the country's vulnerability in the crisis.
Precisely. The argument is that you can't have a truly resilient economy, a fortress nation, if the underlying foundations, education, health, infrastructure, basic equity, are shaky. These weren't just side issues, they were core to future risk.
So, after navigating the storm, outlining the internal fixes, and diagnosing the national weaknesses, what was the final note? Was it hopeful?
It was. But it was a conditional hope, a plea, really, for collaboration. The hope was that the sheer scale of the COVID crisis would force the U.S. to finally confront these deep problems, move past political squabbling, and actually fix them through business and government working together.
Using the crisis as a catalyst for needed change.
Right. Believing in America's underlying strengths, freedom, enterprise, but saying they can only flourish if these fundamental policy issues are addressed.
This has been a fascinating deep dive. We've seen how this fortress organization used its prior strength to pivot incredibly fast, focusing on stakeholders, customers, employees, communities during extreme stress, maybe even before short-term profits.
The preparation really paid off, clearly. But let's go back to that regulatory tension we flagged earlier. Remember Section 3?
Yeah, the point about existing rules potentially limiting their ability to deploy more capital in the worst-case scenario?
Exactly. The letter explicitly says that regulations could constrain actions by healthy, well-capitalized banks during severe stress, even when they have plenty of resources. So here's the provocative thought for you, the listener, to consider.
Okay.
Did the rules designed to prevent another 2008 while making banks safer perhaps also make them less flexible? Does a crisis like 2020 suggest we need to rethink how those regulations work in extreme events to allow strong institutions to provide maximum support when the economy desperately needs it?
That's a huge curl in safety versus flexibility in a crisis. Definitely something to chew on.
It's the core trade-off.
Indeed. Well, thank you for joining us on this deep dive. We'll catch you next time.